Hi, I'm David Armstrong, Managing Editor of WealthManagement.com. I'm here with Brad Hinton, who's the Director of Research and Portfolio Manager with the Weitz Funds. Brad, thanks for taking the time.
Thank you, David.
The Weitz Value Fund. It's had a good track record over the past several years, beating the S&P 500 a couple percentage points. What's your strategy there?
Yeah, so our approach is really to think like a private business owner and look at the company behind the stock. What we're trying to do is understand what a rational private owner would pay to own 100% of a business and then buy shares at significant discounts to that business valuation. So the key for us is really twofold. First, we've got to value businesses appropriately. It's what our team does all day, every day. And then second, we've got to be disciplined. We've got to take advantage of the emotions of other investors, try to buy when they're fearful and sell back to them when they're greedy.
So one of your top holdings recently was Microsoft. I know you've sold off a little bit of that. Are you moving away from technology?
Well, we're still big technology investors. Microsoft is one that we've taken down the list a little bit just because of valuation, really. And we've been moving more towards something more controversial, which is Hewlett Packard right now. It's a business where they have some issues in the services segment, in the printing segment, but we feel like the business isn't broken. It trades at about 5 times earnings, and we feel like over a 3-year horizon, Meg Whitman's going to get some of those things cleaned up and get the business back on the right track.
Okay, maybe she could do more for Hewlett Packard than she did for Yahoo.
Perhaps, yes.
And what about financials? I know you've weighted pretty heavily towards financials. Is that a smart place to be right now?
Well, we're looking at specific kinds of financials. So Aon Corp is a big holding for us. It's an insurance brokerage business and a human resources consulting business. And the insurance brokerage is really a toll booth business. It's not something where they're taking insurance risk. They're essentially taking something off the top of global risk. And
it's a reinsurer.
It's been a little bit soft over the last couple of years, just because global business activity has been low. But as that recovers over time, we think there's a fair amount of upside there. It's a $47 stock. They've got over $4 of cash earnings as we sit here today. We think that both sides of the business have the ability to expand margins over time. We should see a pretty nice growth profile over the 3 or 5 year horizon that we're looking at.
Mm-hmm. And Wells Fargo, Wells Fargo still holding?
We still are holders of Wells Fargo. It's really the big bank that we feel most comfortable with because of the credit culture that they've got there and the dominant position they have in the mortgage market. They've been something like a third of the mortgage market most recently, outside of Fannie and Freddie, of course. Mm-hmm. And we feel like basically the underwriting culture there gives them an edge over a lot of the companies that had more difficulties coming through the financial crisis. Mm-hmm. The business isn't as attractively priced as it was a year or two ago, but still something that we feel good about for the long haul.
Any other new purchases that you can talk about?
Valeant Pharmaceuticals is one that we feel very good about, and it's basically a collector of cast-off brands that the larger pharmaceutical companies feel like they can't do a lot with them anymore, and they're really a value investor of pharmaceutical brands, and less patent risk than you'd have at a lot of other companies. Still have some organic growth, out buying brands on a regular basis, and good portfolio allocators.
Excellent. What's the ticker?
VRX.
VRX. Okay. Well, Brad, thanks very much. Appreciate the time. Thank you.